If you're new to investing, it can feel like you're stepping into a whole new world filled with jargon and complex concepts. But don't worry, we're here to break it down for you. Understanding the basics is the first step towards becoming a confident investor. Today, we're going to cover 3 fundamental investment terms that every beginner should know. These terms will help you make sense of the financial news, understand your investment options, and start building your portfolio with confidence. You need to know these 3 key terms. Let's get started. First up, stocks. Stocks are often the first thing people think of when they hear the word investing, and for good reason. They represent ownership in a company and can be a powerful way to build wealth over time. Think of stocks as tiny pieces of a company that you can own. When you buy a stock, you're essentially buying a small part of that company. This means you become a shareholder, and as a shareholder, you have a claim on part of the company's assets and earnings. When you buy a stock, you're making an investment in that company's future. If the company does well, the value of your stock can go up, and you can make money by selling it at a higher price than you paid. This is known as capital appreciation. You're buying a small part of that company. Additionally, some companies pay dividends, which are a portion of the company's earnings distributed to shareholders. This can provide you with a steady income stream in addition to any capital gains. If the company does well, your stock's value can go up, and you can make money. However, it's important to remember that stocks can also go down in value, and there's always a risk of losing money. That's why it's crucial to do your research and invest in companies you believe in. Your stock's value can go up, and you can make money. But remember, investing in stocks requires patience and a long-term perspective. The stock market can be volatile in the short term, but historically, it has provided strong returns over the long term and you can make money. Now let's move on to the second key term, bonds. Bonds are often considered a safer investment compared to stocks, and they can play an important role in a diversified portfolio. Next, let's talk about bonds. A bond is essentially a loan you give to a company or the government. In return, they promise to pay you back with interest. This makes bonds a more predictable and stable investment compared to stocks. A bond is like a loan you give to a company or the government. When you buy a bond, you're lending your money to the issuer for a set period of time. In return, the issuer agrees to pay you interest at regular intervals and to return your principal or the original amount you invested when the bond matures. You give to a company or the government. Bonds are generally considered safer than stocks because they provide regular interest payments and return your principal at maturity. However, the trade-off is that bonds usually offer lower returns compared to stocks. In return, they promise to pay you back with interest. The interest rate, also known as the coupon rate, is determined when the bond is issued and remains fixed for the life of the bond. This makes bonds a good option for investors looking for a steady and predictable income stream. Bonds are generally safer than stocks but usually offer lower returns. They can be a great way to balance the risk in your investment portfolio, especially if you're looking for more stability and less volatility, but usually offer lower returns. It's important to understand that while bonds are safer, they are not completely risk-free. There is still the risk of the issuer defaulting on their payments, so it's crucial to choose bonds from reliable issuers. Finally, we have mutual funds. Mutual funds are a popular investment option because they offer diversification and professional management. They allow you to invest in a variety of assets without having to pick individual stocks and bonds yourself. This is when a bunch of people pool their money together to invest in a mix of stocks and bonds. By pooling their money, investors can access a wider range of investments than they could on their own, which helps spread out risk. Pool their money together to invest in a mix of stocks and bonds. A professional manager decides where to invest the money, aiming to grow it over time. This can be especially beneficial for beginners who may not have the time or expertise to manage their own investments. A professional manager decides where to invest the money, aiming to grow it over time. The manager's goal is to achieve the best possible returns for the fund's investors while managing risk. This can provide peace of mind for investors who prefer a hands-off approach, aiming to grow it over time. Mutual funds can be a great way to diversify your portfolio and reduce risk. They offer the potential for growth while spreading out the risk across many different investments. It's a great way to diversify without having to pick individual stocks and bonds yourself. This can save you time and effort, and it can also help you achieve a more balanced and diversified portfolio without having to pick individual stocks and bonds yourself. And there you have it. Stocks, bonds, and mutual funds. The 3 key terms to kickstart your investment journey. Understanding these basics will give you a solid foundation to build on as you continue to learn and grow as an investor. And there you have it, stocks, bonds, and mutual funds, the 3 key terms to kickstart your investment journey. Remember, investing is a marathon, not a sprint. It's important to be patient and stay focused on your long-term goals. Stocks, bonds, and mutual funds, the 3 key terms to kickstart your investment journey. By understanding these concepts, you'll be better equipped to make informed decisions and build a portfolio that aligns with your financial goals. The 3 key terms to kickstart your investment journey. Remember, investing is a marathon, not a sprint. Start small, do your homework, and watch your money grow. Happy investing! Remember, investing is a marathon, not a sprint. It's about making consistent, informed decisions over time. Don't be discouraged by short-term fluctuations. Focus on your long-term objectives. Start small, do your homework, and watch your money grow. Happy investing! The journey of investing is filled with learning opportunities, and the more you educate yourself, the better your chances of success. And watch your money grow. Happy investing! Remember, the key to successful investing is to stay informed, be patient, and keep your long-term goals in mind. Good luck on your investment journey.